Welcome to Market Call. Happy Monday. David Burrows is on the show, President and Chief Investment Strategist at Barometer Capital Management. He'll be taking your questions on North American large cap stocks. Call David toll free right now, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. David, great to see you.
It's great to be here, Andy.
We've seen U.S. stocks hitting record high after record high this month, and you say that that is a good sign.
Yeah, it really is. So a couple of things. When the market has gone sort of over 18 months without making a new high, and then eventually you do make a new high, if you go back to 1950, the market has been up 100% of the cases a year outside of 1 year, and that was in 2007, which we know what happened next. And not just that, 1 year, 2 years, 3 years, all significantly higher. So on average, about 13% for the year. Now, it's interesting because it correlates with the fact that we're in a re-election year. You've got an incumbent president, and when the midterm year was negative and you were headed into election year, same thing, 100% of the cases mark it up an average of 13%. So we started out January well. We've had like 5 net new highs in the last month, and it bodes well for the rest of the year.
What was that about the midterm negative? I didn't quite catch that, David.
If the midterm year was negative, which would have been 2022.
Okay, yeah, which was terrible.
Which was terrible.
Yeah.
Then the election year was positive, 100% of the cases since 1950.
You have a couple of charts. First, one showing foreigners' sales of Canadian equities, purchases and sales. So it looks like there's been some divestment lately.
Yeah, it's really interesting because we know the U.S. market's been doing well, but over the last year, a bunch of global markets have wakened up after 15, and in the case of Japan, like 30 years. And Canada tends to be more correlated because we have a big financials weight, a big industrials weight, and really the Canadian market got going over the course of the last year. But lots of people betting against economically sensitive markets, and the Canadian market is. So the positioning doesn't really square up with what's happening under the surface, which we see substantial improvement in breadth and new money getting put to work. So ultimately, I think there could be a fair bit of money squeezed into Canadian stocks.
A fair amount of money could come back to Canadian stocks?
To Canadian stocks, right. So lots of people have made bets against our domestic economy. Of course, we got a lot of companies that are not just so focused on the Canadian domestic economy, especially some of our industrials. So it's interesting, the setup for Canada, as well as Latin America and parts of Asia, really interesting, not just the U.S.
And you have another chart for us showing the earnings recession in the United States. So we went negative on U.S. S&P 500 earnings. What's the pattern we're seeing here?
Yeah, so just to be clear, this is a chart of earnings growth, okay?
Change.
So earnings contracted, right. So Q4 of 2022, they aren't losses. Yeah. They're reductions. Yeah. And what's interesting is the market tends to turn prior to earnings. And we know that we saw a low in stocks in October of 2022. And we had, since then, earnings growth has been slowly improving. This quarter, should be around 5%. It's actually coming in a little bit better than that. Sales are coming in a little bit better. But the expectation is by the Q4, earnings year over year could be up 15%. And so that's important to recognize that the market doesn't often sync up with what's actually happening in the economy. We're looking ahead.
Oh, so the blue bars there are projections.
That's exactly right.
And so your feeling here, is that a good sign? I mean, 15% year-on-year earnings growth would be great.
Of course, when you've got all kinds of folks who have made big bets that we're headed to a recession, right? We have very high cash weights, and some of it's corporations, but a lot of individuals have a lot of cash. A lot of people pull money out of the market thinking we've geopolitical risks and all these other things. The market climbs a wall of worry, and it's really hard to remember by the time the news is all good, it's probably time to get a little more defensive. Yeah. So it's just important to be looking for these market signals.
David Burrows is our guest today. David is President and Chief Investment Strategist at Barometer Capital Management. The topic, North American large cap stocks. The number, 1-855-326-6266. Okay, we're back. Shahab has sent us an email. The subject is advanced micro devices. Do you have a price target? What is your notion of this stock?
So, Andy, it's always important to watch the semis, because the semis are kind of like Dr. Copper used to be, or maybe still is, and it's an important input, and they go into everything. Of course, everyone's made the bet that NVIDIA is the champion in AI, and we own it. But that being said, we also own AMD. We think that likely you're going to see all kinds of interesting custom chips get built. AMD, has some interesting solutions, and you've seen some recent endorsements that people would look beyond NVIDIA to say, what else could we be looking at to source? So I think AMD looks just fine, and I think that tech is not the only place to be, but it's an important place to be for some of the money.
We have an email from Jack. Jack is asking about Asana, which is one of these workplace collaboration software companies, among other things. What is your take on ASAN?
Look, it's a loss-making company. It's a company that's really not generating a lot of cash. I think there is a real distinction. We have gone from a world where the power is in the hands of the borrower, or the companies that need funding, to the power being in the hands of the lender. And so in general, we would stay away from tech-related companies that are not making money, because there may not be as much free money in the market to fund these things. So just in general, this is the type of company I would avoid. There's a lot of companies like this in the ARKK ETF, which is sort of the tech innovation ETF. Be a little more cautious there. We prefer companies right now in any industry that are big cash flow generators, because they have the future in their own hands.
Okay. Elliot in Hamilton, Ontario. Go ahead, please.
Please. Rockwell Automation, ticker ROK. Thank you.
Thank you.
So we are in general very bullish on the industrial sector. We have an industrial renaissance going on in the U.S. You've got a lot of reshoring of manufacturing. And a lot of the new manufacturing requires, clean energy, because, you need a good power source for a lot of these sort of automated systems. I think Rockwell Automation is an interesting company. We own Eaton Corp, is our sort of key holding in the electrical power equipment market. But I think it looks okay. Frankly, the relative strength recently has been a little bit weaker. I would prefer ETN versus Rockwell.
What's ETN?
ETN is Eaton Corp.
Oh, yeah.
Right? Okay. And Eaton Corp is electrical equipment for sort of automation and precision manufacturing. It'd be more inclined to go in that direction.
We have Ross in Windsor, Ontario. Fire ahead, Ross.
Hi there. I'd like David's opinion on Waste Connections. I'm a long-term holder, and that's got a pretty high valuation right now. I'd like his opinion. Thanks.
Thank you.
So when we get into a bull market, the thing you want to be careful of is the downgrades based on valuation. In the really great companies that execute, they tend to continue to beat estimates. And when I look at the chart of Waste Connections, we own it. It had a period from about September of 22 through until September 23, October 23, where stock consolidated and then broke out. So we're trading at a new all-time high. They've continued to execute. Estimate for fiscal 23 is a 30% growth rate. As long as these companies continue to execute, and Waste Connections has done a really good job, I would be there.
Okay, we've got Greg calling from Toronto. Go ahead, Greg, please.
Good afternoon, Andy and David. Thanks for taking my call.
Pleasure.
Wanted to ask about Raytheon specifically, but more broadly, the defense stocks now, and whether David feels they will outperform the index over the next 5 years. And is an individual stock pick best, or better to buy a defense ETF? And would he know one? Thank you.
Okay.
Thank you.
So look at, I haven't spent any time on Raytheon, but I can tell you that we like the defense sector. We have significant stakes. The biggest company that we own is General Dynamics. And we think that tension in the South China Sea is not going away anytime soon. General Dynamics builds for the Navy submarines and naval ships. They also build the Abrams tank. Seems to be some destruction going on in Abrams tanks these days. And in general, we like defense for a couple of reasons. One, because geopolitical risk is not going away. Countries are expanding their budgets. They're good customers. They pay their bills. And the most important thing about defense that we forget sometimes is they are like a giant skunk works. They are always developing stuff that we know nothing about until it comes.
Yeah.
And so there's this optionality inside the defense stocks that is really interesting. So we own General Dynamics. We own Howmet, which makes precision parts for aircraft. These are two companies, I think, that are really attractive. And actually, the ETF XAR is a way that you could get the basket of defense stocks, which I would suggest. So I'm sorry I don't have more for you specific on Raytheon.
Right. What was the ticker on that defense ETF?
XAR.
XAR. Okay, and people can look out for that one, the Spider S&P Aerospace and Defense ETF. We're going to be back with David Burrows of Barometer Capital. He is taking your questions on North American large cap stocks. Owen is on the line from London, Ontario. Fire ahead, Owen.
Hey, how's it going, Andy and David?
Not bad, thanks.
Just a question about cargo jet there. I bought earlier on in the year about 109, and I'm just curious what you gentlemen foresee it going in the future. Thank you, and I'll hang up and listen to your response.
Thanks.
Okay, so cargo jet obviously had, a significant pullback over the last couple of years. Pulled back to lows around $75 and now trading all the way back at 120. I think that it's had a wonderful move. We own the stock, and it looks as though sort of forward guidance is getting better. They're doing a lot to manage their load factors and their profitability. Technically speaking, it's a little bit overbought. If you were to take a look kind of like at the 200 week moving average is down around $100, it's not impossible you could see this pull back, 10 or 15 bucks. But that being said, we like the stock. We like it fundamentally. We think that things are improving. 2024 estimates like a 25% earnings growth over 23, pretty attractive. And we do think that the economy likely, weathers this little storm that we're worried about and continues to get better. And transports, I think, look pretty good.
Let's head to Ottawa. Don, go ahead, please.
Yeah, thanks, Andrew.
Pleasure.
David, I'm looking at pharmaceuticals, and I can't help thinking that Pfizer must be a good buy somewhere down here. Thanks very much.
Sure. Okay, so Don, here's the difficulty. Pharma right now is made up of haves and have-nots. And the haves are the GLP-1 drug companies. We own Lilly. And I know it looks expensive, but, I think that it likely will be the biggest drug in the history of the U.S. And is not showing any sign of letting up. In fact, adoption continues to improve. So you got Lilly, which looks good. You got Vertex, which looks good, and they have their cystic fibrosis drugs. The problem with Pfizer is there's just really not very much growth. Yes, it's paying a 6% dividend, but you can see it's being used as a source of funds to go somewhere else. The stock has been under pressure for quite some time now. In fact, over the last 2 years, I think that if you look at the characteristic of the company, it's a high dividend yielder with no dividend growth. And if you looked at utilities, they look about the same as this one does. And if you looked at some of the other bond-like proxies, they look the same. I don't think we're in a world where you want to look for a high dividend with no dividend growth. I would look for a lower dividend with significant dividend growth. If we've moved into a regime where we're likely to see rising rates over the next, and I believe this, 10 or 15 years with interruptions, then we want dividend growth. That's what works in a rising rate regime.
Rates could actually go up from here over the long term.
Absolutely. I think we saw a generational low in 2020. If you look at long-term interest rates, they put in generational lows, like every 40 or 50 years. The last one was the late 1940s. And rates were at 1.6%. They went up from then until 1981. So I do think that we're going to see them pull back a little bit in here over the next few months. But likely, the next cycle, we're going to get to a higher high.
Wow.
And so in that environment, dividend growth becomes really important because you're offsetting the impact of rising inflation. And if you look at the dividend-paying cohort, and there's an ETF, RDVY. RDVY.
Okay.
Which is made up of companies with an innate ability to grow their dividend. And if I were to compare that against FDL, which is high dividend payers, there's very clear outperformance, one theme versus the other. So we would focus more on dividend growth and dividend growers.
And part of your longer term higher interest, there we go. There's the rising dividend ETF, okay.
Yeah.
Big government borrowing requirements, will that help push up interest rates as well?
I think that if you don't have dividend growth, so I think that we are in a reflating world. I mean, look no further than Japan. They have inflation for the first time since they turned down in 1991.
Wow.
Right? They've got 2% inflation, and they are over the moon happy about it. So, it looks as though there are lots of things that can cause more persistent inflation over time, and it's not going to go straight higher. Likely we back off a little bit, and then we go to a higher high. And in that world, dividend growth is the theme. What works in rising rates is different than what works in falling rates. High dividends are like bonds. They work in falling interest rates.
Okay. Chris in Hamilton, Ontario. Go ahead, please.
Good afternoon, gentlemen. Thank you for taking my call.
Pleasure.
I'd like David's view on Salesforce. It's had quite a rise in price in the last little while, and I just wondered if maybe it would get overvalued and this would be a good time to take profits and possibly invest the proceeds in NVIDIA or increase my holdings in NVIDIA.
Right.
Thanks.
So here's the $64,000 question. The outperformance of U.S. stocks over the last 10 years is twice as much as what happened in the 90s and twice as much as happened in the Nifty 50 in the 60s and 70s. In both cases, eventually, global stocks started to outperform, a huge valuation gap. And tech really, obviously has been a sweet spot because, AI, of course, in the last year has been a really important theme. And so people have looked for places they can use to take advantage of that. Microsoft, of course, is one huge distributed subscriber base. CRM is the same thing. This is an obvious one for the deployment of AI technology, as is NVIDIA. These are all great companies, and I'm not sure you trade one for the other. That's one part of your portfolio, and it works until it doesn't. They are exceedingly expensive, and at some point, they can certainly pull back. I would argue for new money, you want to look at some other sectors that are trading at big discounts and are under-owned, but I wouldn't trade CRM for NVIDIA. I think they're both great companies. You're participating in the theme. Sit tight.
We have an email from Richard. Richard is asking about Mobileye, MBLY, on NASDAQ. I bought it just before its huge drop a few weeks ago. Should I sell or lower my average cost? Can you remind us what they do, David, please?
Yeah, so Mobileye is technology that is meant to be used for autonomous driving. Right, and this is something that Tesla does not use. They contend that this is not necessary, the technology that Mobileye has. Here's the bad news. I've never seen anybody get wealthy buying a value tech stock.
Yeah.
Company is, it's making a little bit of money, but their future is kind of murky. I'm just not one to pick up, dimes in front of a bulldozer. The trend is negative. I think that you'd want to be really careful. Just remember, every single shareholder is unhappy. There's not one happy shareholder. And as a result, as it rallies, there will be an army of them just waiting for their opportunity to get their money back.
Yeah.
So I'd rather own something that has things that's good getting better, where there's happy stakeholders who are not in a hurry to sell. I think there's other names to look at.
Okay. You're trying to keep the resentment quotient in your portfolio down.
Yeah.
That's interesting. We're going to take a quick break. We'll have a look at David's past picks when we return. David was on our show February 27th of last year. JP Morgan Chase was his first idea. Not a bad move on this one.
Yeah, so look, when we get into a period like we're in right now, where we are back into a sort of rising rate environment, this tends to be ultimately good for financials. Takes some time for things to get rejigged. The XLF ETF in the US made its first new high about a year and a half ago since 2007, right? So it's been through like a 15-year bear market, and that's a secular bear market for the sector and made a new high. And some banks, of course, did it at the same time. JP Morgan is the leader in that sector, made its first new high in 2013.
Whoa.
Right? This was the one. You want to own the leader in the sector, best balance sheet, best managed. They are outspending their competitors in technology by a wide margin. So our view through the course of last year is if you're going to own a bank, you own JP Morgan because they were the last one that would get in trouble. And of course, they've been able to make some pretty sweet acquisitions as the regional banks were in difficulty over the last year. So we continue to like it. It's a core holding, and it's one I think any portfolio could own.
Stantec, the engineering company, not a bad move on these shares either.
Right. So we think that two themes are important, and we're big into finding key structural themes. Infrastructure and reshoring of manufacturing are two important ones. So great for industrials in general, great for industrial construction and the infrastructure construction. Stantec is winning it across the board here. There's a number of companies in this group. WSP is acting pretty well also, even SNC. But these are big beneficiaries of the spending. If you look at construction spending in the U.S., it's gone to a straight hockey stick versus the last number of years. So Stantec is benefiting from that. We also think that there's been a lack of spending in the resource sector. And so engineering in general, we think a pretty good place to be.
And your final idea, ATS, involved in automating manufacturing, among other things, in positive territory.
Yeah, again, you know, you can buy this stock here. Automation is not going away. It's going to be a very important theme. ATS has gotten into healthcare and consumer goods, and they have great expertise and lots of opportunity.
Okay, we're going to be back with David Burrows of Barometer Capital Management. He'll be taking your questions on North American large cap stocks. 1-855-326-6266. Anita is standing by in Markham, Ontario. Go ahead, please.
Good afternoon, David and Andrew. Thank you for taking my call. My question is on Meta. I don't own the stock right now. I find it quite pricey and overvalued. What do you think of this company, and do you think there's a lot of growth in this? And what would you recommend the entry point to be? I'll hang up and listen to you. Thank you.
Right. So let's just start with the fact that the communications sector has been very strong, specifically not telecom, but the new communications sectors, Google and Meta. You know, Meta broke out early. It broke out in November to new highs. Always important to watch what makes new highs first after the October correction. And, you know, has been charging higher ever since. This is never going to be a cheap stock. If it's a cheap stock, something's broken. They have a tremendous opportunity to scale what they're offering ultimately in augmented reality and many other things. You know, the Apple device that's been launched, you know, is an indication they believe this is going to be a big market. And Facebook has been spending an enormous amount of money in the background in this area.
On virtual slash augmented.
Augmented reality. You know, this is it's a tremendous environment that they can use to generate additional revenues. So we own the stock We know it's expensive. It's about 33 times this year. The expectation is for about 70% earnings growth on the year, and next year a little bit less, sort of closer to 30%. But it's got momentum. So the way we look at this is stay in the leading stocks, use a trailing stop loss in behind, be prepared to limit the amount you're willing to give back. So far they've been pretty good at beating and exceeding estimates. And so we're there. Again, tech for us is about 20% of our portfolio, 18%. So that's an underweight.
Okay, I was going to ask
That's an
you.
underweight.
Yeah.
And it's not because we don't think there's lots of opportunity, but there's some really great opportunities in sectors people hate that have really great long-term setups. So we've been doing some other things also.
Faisal in Toronto, go ahead, please.
Hi, good afternoon, gentlemen. Thank you for taking my call. Andy, you look like a brand new man with that haircut.
Oh, thank you. It's controversial, let me tell you, but thanks.
No, indeed. David, always you are one of the must-watch guests here for the deep, insightful analysis that you bring and the context that you provide around it. And finally, Andy, I just want to give a big shout-out to your support staff. Exceptionally professional, exceptionally polite.
They really are.
They make this show happen. So we are very grateful, and I think I speak on behalf of all callers.
Yep, they're
David,
superstars. You're right. Yeah. Thanks, Faisal.
Yeah. David, can I get your opinion on Cameco? I know our economist, our prominent economist, Mr. David Rosenberg, he's mostly bearish in most stuff. The only thing he seems to be really fully bullish on is uranium. It has pulled back. Would you be a buyer at these points? I'll hang up and listen. And thanks again, gentlemen. Bye-bye.
Faisal, thanks for calling in. So I've actually used Cameco over the last year as one of my top picks here on BNN. And specifically, we do really like uranium as a material and nuclear power as a potential source of baseload power. We see nuclear plants coming back online. We actually own a company called BWX Technologies, BWXT, which is a NASDAQ company, but they've been running small nuclear reactors for the U.S. military since the late 1950s. And these are going to get commercialized. Actually, they're working with Ontario Power Generation here in Canada. Cameco, of course, is the granddaddy in production. There are concerns around Russia's ability to supply the market recently, and uranium prices have been moving up. Cameco doesn't benefit as much as some others because they sell forward their production. But let's talk technicals for a minute. It was the first material stock to make a new high when materials turned higher right after October. The stock has been strong all year long. And now it's just recently exceeded its all-time high from 2006. So I go back to that whole thing, wanting to be in companies where the shareholders are happy, right? This is a theme that is in gear. All the shareholders are happy. There is upside. The earnings should be up this year about 100%, which is, not inconsequential. The acquisitions that they made are working out quite well. So I like the stock. And we like materials as a sector, although it's, I know, contrarian for this upcoming year, but uranium certainly is leading the way.
And you have another top pick in materials coming up. Jacob in Toronto, fire ahead, please.
Hello, yes, good afternoon, gentlemen. Thank you very much for taking my call.
Pleasure.
And you have a beautiful haircut.
Thank you.
I wonder if you want to Vida Sassoon to cut it because it's fantastic. I'm a hairdresser myself.
Oh, my goodness, thank you. I'll pass that on to Abdul, who did it. Thanks.
Anyways, I would like to ask your guest, please, about the Toronto Dominion, if it's to hold, sell, or just keep it. Thank you.
Thanks very much.
Yeah. So, TD has had a rough go, and a lot of it surrounding, questions as to what they knew and when about the, anti-money laundering issues they may have in the U.S. I think that this is a cloud hanging over the stock. It's at a relative strength low versus the sector and versus the market. I think you're better off somewhere else, frankly. We own National Bank. We own Royal Bank, but I I'm not sure I want to go there just right now. I think it's a wonderful company. It's well run, but at this point, it's just a real laggard. And I'd like to see the stock get going and set up a little bit better technically before I put new money to work. And I'm sure there are value-oriented investors who would disagree with me on that. We're not value-focused specifically. I like to see the technical picture line up with the fundamental picture. You know, I want to see that other people agree that something's going right before we put new money to work. So I'm a little cautious there.
And the Globe reporting a couple of days ago, I don't think we've had any confirmation that they are at risk of a monetary penalty in Canada for alleged money laundering or money laundering control lapses. Right. Yeah.
Yeah, we just think that, you know, when there's something out there smoldering, I'd rather look somewhere else for new money.
Neil is in Cambridge, Ontario. Go ahead, please. I don't hear. Oh, I'm very sorry. It's not a talking email. They don't have those yet. Open text. What's the outlook for open text?
So, you know, open text is in a great sector, right? Software has been performing really well. You don't have to go further than looking at the IGV, which is the software ETF in the U.S., which is just making new highs. You know, we don't own open text. We have a small amount of open text. I think it's a great company. It's just technically breaking out. I think that's positive. I'm going to say we've had mixed results from open text over time. It has been prone to the odd pothole. And so it's not a big position for us. Our bigger position in software in Canada would be Constellation Software, CSU, which has just been a powerhouse. But OpenText, you know, they've got a good earnings growth. This year, for 2024, so it's be like 45% earnings growth. 25 is less clear. So, you know, we'll see. It's not an expensive stock. You know, it's an inexpensive software company, and there's lots of opportunity in document management, of course, for use of AI. So it's an interesting one. I prefer CSU over the OpenText.
Constellation. We had a query from a viewer here, and I must admit I let this slip. You mentioned a NASDAQ company that's involved in small nuclear reactors. What is the name of that?
BWXT.
BWXT.
Yeah.
Okay.
I'll just say one thing. It's interesting. I just read the book, The Pentagon's Brain, and it's all about DARPA, the Department of Advanced Research, that started in the 1950s. And of course, they've developed so many technologies inside of DARPA that eventually wind up in the civilian world 30 years later.
Yes.
This is one of them. Okay, they've been running nuclear-powered submarines since the 1950s.
Wow.
They run really efficiently and really effectively, and I think we're going to see small nuclear reactors get deployed commercially. Microsoft said they'd like to run their cloud business on nuclear power. So, you know, I think that this is one to keep an eye on.
Okay, yeah, and they are involved now in civilian SMRs, are they?
They are bringing it to the civilian market, but they have, you know, 50 years of running these things safely in the military and inside of government.
That's interesting. Okay, David Burrows of Barometer Capital is taking your questions on North American large cap stocks. We'll be right back. Carla is calling from Edmonton. Go ahead, please.
Oh, hi there. I was wondering if I could get your thoughts on NFI Group. I've held this for a while, and obviously it has not worked out. So just wondering if you see positives in the future or whether it's time to cut the losses and go elsewhere. Thanks.
Okay. Electric bus maker?
Yeah, electric bus maker. You know,
bus maker generally. Sorry,
yes,
David.
Yeah. But, you know, topped out in 2017 like $60. And by the time it made a low in the last year, it was in around 7. So obviously very tough go and lots of unhappy shareholders. This is a very tough business, ultimately, to have consistent results in. You know, they're looking forward to 2024 and hope to make a profit for the first time in several years. About 30 cents is the expectation. You know, they still have to execute. So I think that this one's going to be a bumpy ride. And, you know, I understand it's tough to let some of these things go. And maybe it is that they can make a turn here. But again, you're fighting a mountain of unhappy shareholders who have bought the stock over time. So technically speaking, you want to be a little cautious. Now, if I look at the point and figure price chart, it's getting better. It's made a series of higher lows. I would not want to see the stock trade at $12.50 or $12. It would break it down in the point and figure chart. So it's healing a little bit. In the short run, I would want to use a stop probably around $12.50, and I'd trade it that way.
It'll struggle to get above $12.50.
No. If it trades down through $12.50.
Okay, where is it? Is it about 12 though now? I have it at about 12 right now.
Hold on, let me just take a look. Yeah, sorry, $11.50. My apologies.
Okay.
My apologies. So there's support in at this level. If it trades sort of $11.50, it breaks a double bottom, and I'd be a little more cautious.
Okay. Brent is in Calgary. Go ahead, please.
Good day, gentlemen. Help me square the outlook for these various companies that you put forward, which is all makes sense, with the ballooning U.S. debt, which just seems to have gone asymptotic, and the federal government down there has to fund the obligations, et cetera, that eventually bleed into the consumer if, they start cutting them back. Mm-hmm. So that's the one question. The second is just outlook for U.S. dollar. Thanks.
Yeah.
Thank you.
So this is really important to think about. Think about the asset classes we're talking about. Fixed income. Fixed income are debt obligations, and I own zero U.S. government debt, okay? We said earlier on, we've moved from a world where the borrower is in control to a world where the lender is in control. So I don't really want to own anything that has a bunch of debt because funding costs are going up, whether it's U.S. government or over corporations. We want to own companies that generate excess cash. If you have a company that generates more cash than is required to continue to invest in the business, you have the choice to buy back shares, you can raise your dividend, you can go and acquire companies that don't have the ability to do that. So I think that it makes it very clear, I don't want to own anything that has a big requirement for capital that they don't generate on their own, and the U.S. government is one of them. If you look at the last cycle where rates went from 1.6 to ultimately 19% in 1981, stocks went up consistently. From 1951 to 1966, stocks went up 15% a year. Bonds went up 1.6%, and inflation was 1.6%. Right? You need companies that generate excess cash. Mm-hmm. So it's just really important to look at everything that way. I think that bonds don't make a ton of sense. And I don't think that companies that have a lot of debt make a ton of sense. You want to move on. On the U.S. dollar likely, I think, probably goes lower. It was really oversold recently. It rallied. And I think that I would be a seller of the U.S. dollar here in favor of other currencies. And the Canadian dollar, frankly, probably does quite well relative to U.S. dollar over the next while.
Cheryl is calling from Ottawa. Go ahead, please.
Yes, thank you very much for taking my call. On the TSX, what are your views on Kinaxis? It seems to be fluctuating, and at one point, Kinaxis was considered a good company to invest in. So I'm just curious to hear your views on that. Thank you very much.
So Kinaxis had a great run into 2020. And then ran into some headwinds from a financial perspective. They were loss-making in 2021, back to profit in 2022. And it looks as though their profits are going to continue to grow here. So the stock has had a back and forth. Technically is trying to make a turn. The earnings certainly look better. Mm-hmm. We don't own the stock. I'm a little bit more show me, We own some other companies in similar areas, like we own some Lightspeed, mm-hmm. And in fintech we own Visa. I think that looks really, really good. I think that Kinaxis is a bit of a show-me story.
Okay. We have Shane on the line from Fort St. James. Go ahead, please.
Hi. Morning, David. Can I get your thoughts on Vertex Pharmaceuticals? I've held it for a while and I've done well on it. Thank you for your recommendation.
Thank you.
Well, good for you. I'm glad you're there. It really has been a strong performer. You know, if you pulled up the PPH, which is the ETF of pharma producers, you can see that basically it consolidated from 2015 really until recently, October of this past year.
What was the ticker again?
PPH.
PPH. Okay, I'm not sure if we have that one. Oh.
And then if you look at the very long term picture, you need kind of a decade.
Sure.
Anyway, so the PPH is breaking out, and that's good. So again, we always want to own the one that has been winning already before the group really gets going. And Vertex is one of them. So we own Vertex and we own Lilly. Vertex has a really great franchise in cystic fibrosis therapeutics and is growing very nicely and has lots of opportunity going forward. So good relative strength versus the group, good relative strength versus the market. It's not crazy expensive, and think that there's opportunity here. So.
And there's that ETF, and it's near record highs.
Yeah.
Okay, we're going to take a break. We'll have a look at David's top picks. Let's get to those top picks. It's an oil name, Canadian Natural Resources.
Look, our belief is you need to find big structural themes that have gone through some shift, and then things can be revalued. And we know that when asset classes or sectors go through many years of underperformance, when they ultimately wake up, they can put on pretty good returns. And the leaders in the group do even better. So when we look at oil and gas, the oil and gas sector went down 90% from 2014 through 2020 and ultimately reversed trend and recouped a bunch. If you look at CNQ on the very long-term chart, basically made a new high about a year ago and then has consolidated over the last year during the tightening cycle. So this is a company that generates just a boatload of cash. They've paid down debt. They've got very long life assets. They pay a great dividend. In the world that I talked about where you want to own the lender, this company generates so much cash. You're going to see 20% dividend growth off a very significant dividend to begin with, probably 20% earnings growth or cash flow growth. And I think the multiple can double over the course of a cycle. So you do the math on that, you're going to get a pretty solid return. This should be a core holding, I think, in any Canadian portfolio.
Tech Resources, play on metals.
This is a similar thing. Commodities went through a bear market from 2008 through 2021, and through the Fed's tightening cycle, certainly have chopped sideways, and you can see it in tech share prices. But if you pulled the chart back to, like a 20-year chart, you're going to see that, we're basically at the cusp. And you could look at Rio Tinto or a bunch of others. They look the same. I think going forward over the next couple of years in this next economic cycle we're moving forward to, these companies do well because there's been no money spent. Their CB2 mine is coming into production. They said December, January, have been pretty smooth. They're going to have good production this year in copper. Next year, the copper production will double. And again, the cash flow generating capability of these two companies are going to be great companies for dividend investors who want some inflation protection.
Although they have had cost overruns at that QB2, but I guess everybody has on their minds.
Yeah, but you want to buy companies as they are coming into production, as they've worked out the kinks, and this is where this company is now.
Okay, and then the final idea, you mentioned Japan earlier, EWJ, iShares Japan ETF.
Yeah, again, a country that went through a 40-year bear market, 30-year bear market, and has clearly come out. It's been a very consistent performing market over the last year. The Japanese yen has been stabilizing. That's important. If you don't believe in the Japanese yen, you can buy DXJ, which is currency hedged back to US dollars. But this is a great way to play it. This is an inexpensive market that's dominated by financials and industrials. Warren Buffett has been a huge buyer of Japanese stocks over the last year for the first time in many years. And we think this is a great diversifier. Canadians in general don't have a lot of exposure outside of North America because global stocks have been tough for a long time. But when they start to work, they can work for a decade and really can provide some significant portfolio support. We think this is an interesting holding as a diversifier.
I'm just looking at the top holdings here, Toyota, Sony, but then Mitsubishi Financial and Lots of electronic companies. It's amazing how the Japanese have held on to their industrial companies. Yeah.
They have, and they've restructured. And the Tokyo Stock Exchange said about a year ago, you have to do something to start trading above your book values, or you risk being delisted. And in Japan, when people have a rule, they follow the rule.
Oh yeah.
So they've all been out trying to take restructuring initiatives, and the market is behaving exceedingly well.
I read a thing about a plane. It was an accident at an airport. I think the plane might have been going on fire. And the passengers were told, get off, don't bring your stuff. And they all did. They were Japanese. Whereas the rest of us were grabbing our rubbish. Anyway, they survived. Okay, we're out of time on Market Call. Thanks for watching.